We're just going to look at 3 ways you can take a tax-efficient income from your FLEXI ACCESS drawdown account. The general principle here is of tax planning, and they want to pay the lowest amount of tax that we can whilst using the available tax bands and allowances that we have. It's why it's really important to understand your tax bands and how your income from your pension and from your other taxable sources will work alongside one another. And the one area that we have the greatest control in terms of income levels is from a personal pension. The state pension is largely fixed unless you delay taking it. A final salary pension is also largely fixed both in terms of when it starts and the amount you get within certain parameters. And this is completely different for a personal pension. The income from a personal pension is guided by you based on a number of factors, including the value of the plan, how much you need or wish to take as an income, whether you want to pass anything on the underlying investment returns, and on your own tax position. You are restricted in terms of when you can access it, currently age 55, going to 57 from 2028. But other than this, you can take the pension as you wish. And this is where it is crucial to balance that income from the pension in line with your needs and with your own tax position. If you take all of your pension as a lump sum, you'll pay the highest rates of tax. For example, if the pension was £100,000 and you take it out in one tax year, the tax position will be £25,000 tax-free cash, with the remaining £75,000 treated as taxable income. If you had no other taxable income, then £12,570 would sit in your personal allowance, so zero income tax on that. Then 20% on the amount from £12,570 to £50,270, and then 40% from £50,271 to £75,000. So a total net tax bill of around £17,000. This clearly can be avoided by splitting this income out over a number of tax years, ensuring that your personal allowance is used. If that taxable income was all kept within the personal allowance, then it's a saving of approximately £17,000 of tax. Also, please bear in mind that the likely tax rate will be higher on lump sums, and the overpayment will need to be reclaimed using one of HMRC's forms, P55 or P50Z. So at some point in our lives, if it isn't decided for us, we will decide that after much consideration, having reviewed the assets we have, considered our life in terms of our objectives and aims, that we no longer want to work as much or even stop completely. We know, having completed a budget, how much we need in retirement, and that ideally it is aligned with our objectives. We therefore need to understand what our tax position will be, and then how we can best align our FLEXI ACCESS drawdown income with it. We know, for example, that our state pension is a taxable income that we cannot amend unless deferred, and it will start from around our late 60s, dependent on our date of birth. We can therefore look to align our income from the personal pension using FLEXI ACCESS drawdown. And it's quite common that someone will want to take all of their tax-free cash from the personal pension in one go when they decide to access their pension, currently, as mentioned, age 55. This would crystallize the whole pension pot. It would be tested against the lifetime allowance, and it is a benefit crystallization event. And you'll be left with a crystallized pension pot from which anything you take out is then treated as taxable income. There'll be no access to any further tax-free cash in the future from this pot, as it will have all been used up. So you then have 3 choices with this pot. Either you leave it as it is and you take no income, technically nil income, or you can take an income from it, which is taxable, or you can use it to buy an annuity or a fixed term annuity. And the pot will remain in place if you don't buy an annuity, increasing or decreasing in value according to the underlying investment, the cost of the plan, and what is taken out as an income. And to be clear, you can do any of these things at later dates. Start or stop an income, take lump sums, and also buy an annuity. However, taking all of your tax-free cash out has a downside, especially if you aren't going to use it, or if you have an IHT issue, as retaining the tax-free cash in the pension as long as possible gives you that future flexibility. By retaining tax-free cash for longer, more of the fund can remain invested, hopefully for further growth, in a very valuable tax wrapper. The classic example of this is taking £16,760 per year. Assuming no other taxable income, then £12,570 is taxable income but falls into the personal allowance. and therefore no income tax is payable. The additional $4,190 is the tax-free cash, the 25%. Therefore, someone can take out this amount on an ongoing basis without paying tax up until their state pension kicks in, and they can then amend the income accordingly to what they need or are happy to pay tax on. But there are other ways to manage this. Let's take a pension pot of £100,000. We can derive the flexible income from the pension in 3 ways that utilises both the tax-free cash and the taxable income. Bear in mind that you cannot take the taxable element before the tax-free, so it's tax-free before or at the same time as the taxable element. So we've got a £100,000 pension pot and we want to take out £5,000 per year as an income, so 5% of the fund value. We can do this either by crystallising £5,000, so that'd be £1,250 is tax-free cash, 25%, and £3,750 is taxable income. That then leaves us with a pot of £95,000. Because we retain that tax-free cash in the residual pot, it potentially benefits from the growth of the underlying investment. Obviously, the fund value could also fall in value as well. So let's go back to managing this income position. Let's say our uncrystallised fund grows by 6%. Then the value of the pension pot is then £100,700. We can then repeat that same process next year by taking out £5,000. We crystallise a further £5,000, 1,250 is tax-free cash, and 3,750 is taxable. And again, the fund value grows in the following year by 6%. In effect, we are growing the value of the pension in nominal terms. We are taking 5% out, and the pension pot is growing at 6% net. If that continues, then the fund will grow in value over time, and both the tax-free cash and the taxable element will be available for the rest of your life. Effectively, there will be a pot to be passed on to the next generation. So that's the first and most straightforward way. The second is to crystallise a larger portion of the fund and take it out as the tax-free cash. To obtain £5,000, we'd need to crystallise £20,000 of our £100,000 pension pot. £5,000 is tax-free cash, and the original £15,000 is crystallised and remains in the pension invested. The third way is to crystallise £10,000, of which £2,500 is tax-free cash and £2,500 is taken out as taxable income, with the remaining £5,000 being crystallised and left in the pension invested. So when might we use option number 3? Well, that could be where we want to hit a specific level of income without paying any tax, and where we already have some taxable income. So let's say we already have taxable income coming in of just over £10,000, and we have a target income of £15,000. Now, we know therefore that that taxable income that we're getting uses up a large chunk of our personal allowance, but our personal allowance runs up to £12,570. So in order to use up that personal allowance, we take out £2,500 of taxable income from our pension, but that leaves us still short of our £15,000, and we don't want to take any more taxable income. So therefore we can make up this difference here with tax-free cash. So we take out the additional £2,500 of tax-free cash. But in order to do that, we obviously have to crystallise a larger amount from the pension pot. But this means we're not just utilising tax-free cash in order to hit this £15,000. We're using a combination of taxable income and tax-free income to hit our target amount of £15,000. And thus it means that we don't pay any income tax on this income. The point here is that we are balancing out what our tax position is and how best to take out our income from our FLEXI ACCESS drawdown account in the most tax efficient manner, whilst also considering what our future tax position might be like.